All right, everyone. So I'm Molly Jane with Blockworks, moderating this panel today. And I thought just a nice way to start is if you guys could each introduce yourself, and then we'll hop into the questions.
Hi everyone, I'm Charles Adams from Nickel Digital. I lead all investor-related efforts. We're a London-based investment manager focused solely on digital assets, with our primary offering being a multi-manager platform.
Hey everybody, Michael Moro, Chief Strategy Officer at INX. INX is a US registered broker-dealer with an ATS license to be able to trade security tokens, RWA assets. We also own a crypto exchange. In addition, we also have an SEC registered transfer agent business as well.
Arben Kane, co-founder of Incentiv. Think of it a layer 1 and layer 0 blockchain that basically is a Shopify of blockchain. And we specialize in the Asian market, especially in Japan.
Great. So my first question is for Michael, but afterwards I think you guys also can answer it because it says it wants you to rely on your experience with institutional crypto brokerage, and you guys probably have all dabbled in that. But so Michael, what macroeconomic trends right now do you think are driving institutional adoption of digital assets?
So, I ran a business called Genesis for 10 years, and I think my experience kind of in that space has certainly taught me a number of different things. I think macro trends that end up being conducive to risk-on asset investment kind of carries over from kind of traditional markets, certainly into the crypto world. I think the last few years we've seen kind of higher interest rates and higher inflation. I think certainly has not been helpful for kind of risk assets kind of across the board. But I think the view around rates kind of coming down, inflation certainly being under control, I think are certainly two key factors here that can certainly drive continued adoption. But I think some of the larger kind of factors that can certainly influence adoption of digital assets and kind of crypto generally are going to be around kind of general acceptance of the asset class. I don't think Bitcoin is this new weird esoteric thing anymore that it certainly kind of used to be. I think that certainly helps. Obviously, kind of the creation of kind of the ETF products I think certainly helpful. And obviously, we've all touched on some of the kind of the regulatory aspects of kind of the new administration. I think all of these things are naturally tailwinds into kind of adoption of crypto, and then eventually into kind of the tokenization of digital assets, I think, as a whole.
So if anyone else wants to hop in, you also could answer the flip end of the question, if any macroeconomic trends are actually slowing down this sort of adoption.
So I think the big one's volatility. I think when investors are looking at directional exposure, most of them are still not ready for 80 to 100% volatility. And the ETFs have seen tremendous success, but I think most of the participation has been retail participation. And I think the number one reason for that is volatility.
I think what I'm seeing is that the masses really are interested in microloans, especially when we are implementing our solutions in Africa. We're seeing that users are just literally on their phone wanting to do microtransactions in a fast way, leverage their salary that they can now basically validate through a blockchain solution. And based on that, it very quickly is building an ecosystem of onboarding that I haven't seen before. So this, when I've seen the DeFi flows and the meme coins and the NFTs and all these trends kind of create adoption waves, they just kind of cracked basically just an awareness element. I think seeing what just Trump did with his meme coin launch excites me because it gets on the news, people ask about it. And now I'm hearing about other presidents wanting to do the same thing. And for me, that's just education for our market. I'm hoping that we're going to skip more into mass adoption by simplifying actually the onboarding process, because to me, that's still the hardest thing that we need to solve for.
I have a further question about Africa. I don't know if you guys read Andrew Chow's book on crypto something. It had one of those titles that all the crypto books have. But he made the interesting point that because FTX made such a big push in Africa, when it collapsed, it really collapsed the African crypto market because they lost this hope and this faith that was like more unique to Africa than other markets. Do you find that that trend has shifted since FTX was a while ago now?
It's shifting, that's what I'm seeing, but it's shifting for the wrong reasons. But sometimes the wrong reasons gave us the internet. So I'm seeing it because the online gambling market in Africa is actually growing quite rapidly. It's being targeted, and they're using crypto as their onboarding process. And so all of a sudden, that adoption is actually now being seen because they're like, oh, wait, I need crypto to actually be able to play these games, right? It's fascinating to me, but now all of a sudden they're like, oh, wait, this crypto went up. So, you know, it's an interesting trend. And the telecommunication providers are just selling the data to the intruders, as I call them.
All right, moving on, this question would be for Charles. So the idea is to answer, in your personal opinion, what are sort of the key risks or the opportunities for institutional investors that are navigating the macroeconomic climate? I know you already talked about volatility, but do you have any other points?
Yes, I think volatility is definitely one of them. I think liquidity is another. You go away from Bitcoin and Ethereum and liquidity really suffers. I mean, if you were trading meme coins when Trump and Milena got released, they just sucked the liquidity out of everything else and you could have just been stuck. But for most part, I mean, 80% of the derivatives volume is split between 3 coins and they're really good. Regulation, it'd be hard not to speak about regulation. It's been a good week, but we need more than an executive order, especially in this jurisdiction. We need bipartisan support. We need bills to go through both the houses. You know, the executive order will make investors look at the space, but they need to see, I use the expression, we're just out the woods. They need to be much further behind us for real institutions to get involved in the space. This does create, though, I think, good opportunities for sophisticated traders. You know, if you're a non-directional fund like we are, the volatility creates some great opportunities. You know, one of our best days in the last 6 months was in August when the market crashed. And crypto is there 24/7. So no matter what happens and when it happens, you can be there and take advantage of it. I also think moving forward, the people that have been pursuing regulation, against the difficulties and the cost in the last 3 years, I think they'll be incredibly well positioned for the next stage of growth.
So you mentioned, the recent orders, executive orders that have happened, but that's just in America. So do you think that America now is going to be differing in the future in terms of how it'll impact digital asset markets?
So America is still the most important economy when it comes to crypto. The majority of capital lies here, and despite some of the noise in other jurisdictions, I think this is why the negative regulatory environment over the last 4 years has really hampered the space or been a cloud that's over it. And I think the jurisdictional risk leaving America and even still here can be quite big. In the UK, I think if you're an institution, it's quite a good environment, but for retail participants, it's tough. Like, it's really, really tough. You're still going to be using primarily offshore exchanges or paying ridiculous fees and ridiculous spreads to actually get in and onboard into the space. Europe has been, as a whole, quite negative as well, but MiCA has just come in. But, wherever you are around the world, we need support from everyone, not just a couple of jurisdictions.
And I also see that countries like Japan, for example, see this new leadership change as something that is making them change their regulations for crypto and blockchain. And in the meetings I had in December, basically it's very clear that they're going to announce their capital gains tax, reduce it, and therefore actually truly enable the Japanese market in this race as well.
Yeah, and I still think, there's a big difference between buying an ETF and then, launching a security token. In 2018, tokenization was going to be the big thing. It's 7 years down the road, and it's still incredibly tough and incredibly expensive to launch a security token.
All right, so this question is more for Arben because it's about layer 1 blockchains. But I'm curious what you think the role of innovation in layer 1 blockchains is to ensure that the digital asset market will stay strong during times of economic crises.
I think it's really, we're seeing this core new term called DePIN, right? And having actually a infrastructure that is something that creates resilience for transactions, for the lifelines of different stakeholders that basically have to have uptime when actually a crisis emerges. I give you the perfect example of what happened with CrowdStrike. Banks went down, hospitals, airlines. DePIN, is the only way forward. We are now a digitally connected global environment, especially after COVID. I think now we need to actually embrace technology and make sure it's resilient for the volume that it's hitting. And we never know what kind of volume or what kind of attacks we are going to be subjected to. We don't know what the other actors have in technologies that actually can attack our networks. I don't think Solana is able to handle a major attack, and prove me wrong. So that's, I think, where we stand now. It's like I'm all about resilience, and because of my background in disaster management, resilience is very dear to my heart. So I've been in disaster management for 20 years, and unless we actually, think about how these IoT devices are secured, how the bridges of those data zones basically are handshakes that we can rely on, or the data that we are referencing when we're utilizing AI. So we have a truth meter, not truth, let's not call it truth because that word is now politicized. A quality meter, let's say that. All of that, I feel like we're in interesting, almost like a new step of what is emerging is that without blockchain, AI can actually evolve into something that truly becomes useful, because we will be able to actually test where did the data come from, is it copyrighted, was there IP on it, and did we use it for this image generation, and therefore can we actually use it for commercial purpose. I think all of that falls into a lot of resilience dynamics in economics and commercialization as well.
So do you think that people are doing enough to think about that disaster preparation right now? Or could they do more?
I think, look, I live in Maui, Hawaii. I went through the fire in Lahaina. I was evacuated. And what failed was the responders. They couldn't handle such a disaster. They didn't know how to handle it. And we see the same thing happening in LA. We're seeing floods in Spain. And what I mean with they can't handle it, it's just like CrowdStrike didn't know how to handle their outage. They didn't know how to even fix the problem for way too long. And no one talks about all the hush that happened in regards to how many people died in the hospital and how much money was lost because, someone was protecting their stock price. So I know all the training materials out there for a lot of countries, and a lot of people are prepared for certain elements, but no one's prepared for such a fire like what just happened in LA. We're now in a different time of humanity. And I work with the DHS and some of the agencies, and they call it adaptive resilience. So adaptive means survive, and then be resilient to figure out how to survive again. And hopefully get back on your feet. So when I see that happening around natural disasters, I think the same thing is going to occur around our technology age. If a solar flare hits us and certain data centers that Amazon is running are going down, what's going to happen?
Well, is DeepIn the answer to that kind of thing?
I think DeepIn is the answer to that, because if we are spread out well, we at least are still operating at a certain basis, and then the data is still safe. We don't know if something's fried. We don't know if something was manipulated, if something is basically being changed. How many people have lost their social security number in the last 2 years because of all kinds of attacks? I know, because I get calls all the time.
And it's a good thing that actually Bitcoin has been tested. Ethereum has been tested. There has been fighting. People have tried to fork it, tried to separate it, and they've survived. I think there's definitely still some chains which are less battle-tested. They still suffer downtime. But if we look at where the majority of the volume is taking place, they have been tested.
I'll add something here. So ultimately, I think a lot of what many people in the room are certainly kind of potentially working on are going to be kind of the on-chain tokenization of stocks and bonds and funds and whatnot, and on-chain trading, I think, kind of generally. I think it doesn't take a genius to figure out that the space is not yet ready for any of that. Not just for resiliency and kind of backup stuff that Arben's certainly kind of been talking about, but we talk about layer one throughputs and how many high-frequency traders are putting in traders, canceling trades, matching trades, all of that stuff at $1 trillion scale. We're not at a place where there is kind of that reliable layer one that ultimately kind of gets us there. And frankly, the settlement's a little clunky. We don't have qualified custodians kind of in the security space to kind of help safeguard some of this stuff. The traditional market makers are not ready to really go 24/7, and kind of the crypto market makers don't have the securities licenses to provide liquidity and kind of get involved in the security space ultimately. And so I'm just like kind of pointing out there is kind of that, pot at the end of the rainbow for it, but I think all of us in the space would, I think, recognize that we have a ton of work to potentially kind of get to that promised land, and institutions like here, like the New York Stock Exchange, I think have a ton of work to kind of get to what if this entire world gets tokenized, and what is their response, and what does their product set ultimately look like?
Yeah, I think every panel and every talk today has said that onboarding to this sector sucks. And I think they're right. It's a lot better than it was 5 years ago. And I'm sure it'll be a lot better in another 5 years, but still today, it's tough. I think everyone, no matter what business they're in, they end up spending half their time educating people about custody and exchange risk and collateral risk, and there's still a long way to go.
But I got to say that the clients are much more educated now than they ever were before. So when they come to us and saying, hey, look, we want to put our healthcare data on chain and want to make sure that people are validated with their ID, and their ID can be validated when they're trying to access a medical facility, and that they actually at the using blockchain as the protocol's validation flow. It's a design partner. So having the design partners, so you're building a solution with them and actually handle the volume issues, so you can deal with volume increases when a pandemic basically breaks out, or when you have a certain flu outbreak. All of those incidents basically allow us to create a testing ground for what this is. It's called innovation. It's not just a solution.
So you guys have talked a lot about the different factors that still need to be worked on that you know about for more institutional and widespread digital asset adoption. But I'm curious if you think there's any macroeconomic factors that are being overlooked that would actually be really important to further the digital asset market and adoption.
I think one factor that certainly kind of pops into my mind, I think there's the process of putting things on chain. I think there's a lot of kind of the democratization of investment opportunities, where we start to break down walls between countries, between continents, and that folks in Africa could potentially invest in NASDAQ-listed securities like very, very easily, and have access to investment opportunities that they ultimately wouldn't elsewhere. But I think as the internet was kind of the first wave of this, but I think as investments and opportunities become investable on a global scale, I think that things that start to happen in foreign countries end up affecting all of us on a much more like higher level than it is certainly today. I don't think kind of as you knock down walls, I think those are good things as certainly investments become, but we're also more susceptible to things that might happen in Asia or in Africa. And I think some of the, whether that's macroeconomic, so interest rates and unemployment and inflation and all of these kind of factors, I think, start to have a trickle-down effect into more markets, into more asset classes than we see today.
Yeah, I agree with that. And adding to that, what I'm seeing is like a trend of stablecoins. Countries finally now deploying stablecoins in their own currency. Because they have seen massive trends of their citizens using Tether as their way of transferring, because it's just simpler. It works faster. They don't have to go to the bank. You had all kinds of businesses pop up where people just took the cash, sent them the Tether, taught them, onboarded them, created a wallet for them, and they became our best advocates. They're like the ambassadors of the crypto adoption wave. I'm like, whoa, because these people didn't even know how to actually They didn't understand, like, wait, do I have to type out the whole wallet address? What if I make one mistake with one letter, Like, those are the questions when you just watch people actually do it, that actually happen. We have a little venture in Korea where we're onboarding around 2,000 to 3,000 new users every day. And all it does is basically gives you a token for recycling a bottle. right? So you just put the bottle in, and we just created kind of a ATM station where a vending machine, they put it in, and then they just get the token in as a text message to their cell phone, and they have to download the app to activate it, right? And I was just like, yeah, I don't know if it's going to work. And I was in Korea just a couple months ago, and I literally saw a grandma doing it with her grandchild. And she was like, brought all the balls, and then I just kind of asked questions. The translator was translating, because I don't speak Korean, not yet. And she was like, yeah, this is how I pay for my bus fare to go to work. I collect bottles, and this is the only way I can pay for it, because this is how much money I need. And I'm like, wow, just seeing that just gave me goosebumps, because I'm like, I saw the direct impact of our industry on such a macro level.
So yeah, completely agree with both of you. I think one thing that we haven't spoken about is the correlation with traditional markets. I mean, the August flash crash was an example of that. I remember waking up on a Thursday before COVID, everything was hunky-dory, everything was fine. Then the stock exchange opened down, and in about a minute, Bitcoin was down 40%. I think that's still a risk, and that instant volatility is something which investors have to be educated about and have to be prepared for.
All right, I think we have time for one more question. So even with like all of the issues that you guys have been talking about with digital assets from like a macroeconomic perspective, do you think that digital assets are still actively being adopted as a hedge against currency instability in emerging markets?
So, I mean, this all depends kind of where you are and what country you're in. I think this idea that some people think that everyone in crypto believes that, you know, the central bank, whether it's the Bank of England or whoever else, is trying to steal your money from you in the middle of the night. And I don't think that's quite true. So I think it really has to prove itself. But if you look at the countries that have the highest adoption rates, it's actually excluding America, it's Lebanon, it's Argentina, it's Turkey, it's places that have unstable currency, to say the least. And if you're in those countries, actually something that could be down 40% is either the lesser of two evils or is a huge positive. So I do think we're starting to see it getting adopted, but as a mainstream hedge, I think it's still got a lot left to prove.
I agree. I think the number one safe haven still remains the US dollar for these folks. And if they have access to the US dollar, I think that's kind of where they end up trying to park their assets in times of high inflation, high volatility, and kind of uncertainty of their own currency. And if you can't access the US dollar, that's where the tethers and the USDCs, kind of the synthetic dollar plays ultimately come in. I think those two kind of verticals will remain kind of the safe haven assets. I don't think that, you know, the folks will say, you know, I don't want my currency. Bitcoin is a safer play. It could be kind of in retrospect, but if you have access to the dollar, I think that's kind of the first place you probably go to park your assets.
Yeah, you're bang on right. I mean, I was in Argentina, and I was so curious to be speaking to people there about, you know, you see all these articles and people say, you know, go to these countries, they love it. It's a hedge. And I was in northern Argentina in a bar, and I was asking everyone, like, oh, did you use crypto? The only crypto that they touched was US dollar stablecoins. They didn't understand why they would touch anything else. And they said if they wanted something other than that, they would just buy Brazilian reals or something which they have. It's super easy to buy, super accessible. And that's why stablecoins have seen such huge adoption. It'd be great to start to see, you know, Biddle lowering their minimum subscription from 5 million to maybe $1. So great, more people could participate. But no, completely agree.
Yeah, I think for me, like when I see these little tiny trends where it's like, especially from a personal experience, when people like, I go and pay at a restaurant, it doesn't matter if it's in Bangkok or Phuket or in Hong Kong, and all of a sudden they're like, yeah, you can send me Tether on Tron, please, on the Tron network, you know? And I'm like, wow, like just that leap that they understand that the transaction fee is actually lower is like a good indication for me that, hey, people are getting it, right? And then so I think it's happening. It's just, you know, it's happening very slowly. But yeah, there's no hedge right now, in my view. Digital assets are not a hedge yet.
All right, well, thank you guys all so much for participating, and enjoy the rest of the conference.